Essentially, what a range is BFIs stacking orders. BFIs are banks and financial institutions. So what happens is their orders are so large they can't actually fill them in one go. So what they'll do is they'll start taking sells and buys, and they'll create a range and basically park price till they've acquired enough positions. Whether it's 50,000 lots, 30,000 lots, 100,000 lots, I have no idea. But they can't just go ahead and put in an order for 50,000 lots of euro because the market actually won't have the liquidity to fill that. What that means is if they want to buy $1 billion worth of euro USD, somebody needs to be selling $1 billion worth of euro USD. And their orders being as large as they are, a lot of times the liquidity is not there. So what they'll do is they'll start taking buys and sells, and basically this will continue going through this whole range until they've acquired enough positions. They're basically generating their own liquidity. Basically, they're selling to themselves because BFIs have that much money and they have the ability to generate their own liquidity. And all we're trying to do is not be in the middle of all this. So this is where premium versus discount pricing is going to come in. If you are trading a range, because a lot of times you will be if you're a day trader, you're only going to want to buy from the bottoms and you're going to sell from the tops. So the bottom's called discount pricing, the top's called premium pricing, and we'll get into this in a little more detail. I just want to finish explaining a range. So once all their buys and sells have taken place and they've acquired enough positions, let's say 50,000 lots is the desired amount, and they're running a buy program, what's going to happen is they're going to leave this range and initiate their price moving away. What happens at this point is all the buy orders they took are now in profit. However, all their sell orders are in drawdown. So what they'll then do is push price back down and they'll start dumping their sell positions wherever. Some will be at a loss, some will be at break even, and they might even get a little bit of profit on a few of them. They don't really care about those. All they care about is getting out of their sell positions. Then they'll hit a demand zone, and ultimately what will happen is then price will begin. And they'll basically keep holding their buy positions and start selling them off towards the top. And whether that's days, weeks, months, nobody really knows. They hold them much longer than we do. When you have the ability to generate your own liquidity, you can sit on these positions for months without it really costing you any money. So this is where premium versus discount pricing comes in. A lot of times we are trading a range, so if you are going to be involved in a range, the idea is to get a decent price for your investment. So let's just talk about that a bit. So you have premium pricing, relative equilibrium, and discount pricing. And just so everybody can see my fib numbers, the orange line is 50%, that's equilibrium. 10% on either side of that is still relative equilibrium. And what that means is essentially anything in here is fair value, whether you're buying or selling. If you want a great deal on your sells, you want to be anything above 50% is a great deal for a sell. Anything below 50% is a great deal for a buy. So you're buying a discount, you're selling a premium. And the higher you get your pricing when you're selling, the better. The lower you get your pricing when you're buying, the better. But the fib basically just lets us know if we're getting a good deal or not. So to put that into action, you'll run it from the impulse where it begins to the impulse ending. And essentially what you're looking for is to get into the relative equilibrium territory. And once you're at this point, you are getting a fair value, which means you're not overpaying for your investment. But the lower it goes, the better deal you're getting on your investment. And once your investment moves up in price, you start liquidating your positions. The same thing happens in the sell scenario. You pull from the top of the impulse to the bottom of the impulse, and essentially you're wanting at least relative equilibrium for your sell position, preferably above 50% if that's possible. The market's not always going to play out perfect where the fib works for you every time, but a lot of times it will. So here you can take your sell positions and start dumping them once price gets lower. Again, the only purpose of the fib is to really keep you from getting ripped off. And what happens in the middle is actually where most of the orders get stacked. When we get on the real live chart, I will show you guys exactly what that looks like. And the idea is you want to stay out of that middle completely. Nothing good happens from it. So we buy from the edges, we sell from the edges if we're going to play a range. So The range I drew for you guys was equal highs, equal lows. This is a more realistic version of a range. And what they'll really do is just start shooting price up and down and basically park price. And what you really have here is a range from, wrong tool. What you have is a range from this bottom to this top. And essentially, anything that's completely in the middle, you're just going to want to stay out of, because they're just going to keep stacking liquidity, and every time they stack liquidity, they run it. They'll stack more liquidity, they'll run it, they'll stack more liquidity, run it one more time, and then ultimately they decide it's time to leave the range. I guess this would be a more accurate drawing of the range, but what you're actually looking to do is just avoid this altogether. You can take sells up here all day long, buys down here all day long, and at least you know you have a chance at your investment making you money. Whereas the middle, you don't have a very good chance. Now, once price decides to leave the range, it'll usually come back to the range as they're mitigating out of their positions. And this is where your best trade happens from. This scenario happens over and over on every time frame, on every pair. And we'll get into that a little bit more as I show you guys how pricing and ranges work in a real scenario. I'll give you an example of a range wipe and how a range is ultimately created and how orders are stacked. And basically the idea is, so this is on the 1 minute, and I'll show it to you on the 15 minute as well. What ends up happening is they basically just stack orders and they leave a bunch of liquidity behind. This is BFIs I'm talking about. Then they'll run that liquidity. They'll stack more liquidity. And this will basically happen over and over and over. And they'll basically just keep running all this liquidity up and down. And the idea is that if you are involved in any of this, again, you want to be buying from the lows, selling from the highs. So if we just pulled say you only had this to work with in the beginning, you would know right away just from this little range that you had that was created. You would take your buys from here and you would take your sells from up here. Anything that is sort of in the middle just becomes liquidity and gets run, and you can see how price moves around that 50% mark. You really want nothing to do with it. Now, as the range expands, so does your fib. And essentially, if you're taking orders on any of this, obviously this will have to come into higher time frames, such as 15, for you to build a proper narrative. But a lot of times when you are playing in the range, you're just playing the edges. And the idea was just to show everybody how a range stacks. Again, you're going to stack a bunch of liquidity, and essentially this liquidity is just going to get run over and over. And this happens basically non-stop, over and over and over. They just keep creating ranges, they keep wiping ranges, and this is ultimately how BFIs stack their orders. Now, I could pretty much go on with this forever. I think I've kind of shown you guys enough examples, you get the point. Now, if I was to pull a 15-minute order block, you'd basically have an order block up here that initiated lower prices. In this exact scenario, I believe price is bearish on the higher time frame. So again, you'd find some kind of, you'd be looking for your big trades from here, from higher up. And if you were to pull the fib on this, now this would be a 15-minute fib. I'm just pulling around to 1 minute to show you. But you can see you're well priced in the premium, great area to sell from. Even if you were selling from here, again, you're properly priced, you run the week lows. Ultimately, the move doesn't happen until here. Now, I mostly use the fib on the daily and the 4 hour and a little bit on the 15 minutes. But the only thing I really use it for on the 1 minute is to basically show me where it's okay for me to get involved in a range. So if I am playing in this, again, we're just playing the edges. And once you train your eye, you won't really need the fib so much because you'll just know where the middle is. Now, if we really dial in on this and look at it, you can see how many times liquidity's been stacked and wiped. Again, liquidity gets stacked in here, and ultimately it gets wiped. And this just happens over and over and over until they finally decide to move price. And ultimately, once they've had enough and they've stacked their orders, you can see pretty much liquidity gets stacked, stacked, and they just keep running all their stacked orders. Liquidity gets stacked, And then the real move comes, and as you can tell, the real move is obviously with higher time frame order flow. And we'll get into more of this when we get into the liquidity topics. I just wanted to show everybody what a range essentially is and how to kind of play it. We'll get into more examples when we get into the end of the course where we're putting it all together. I want to frame some buy scenarios and sell scenarios and basically put all the concepts together. Now I want to show you something here. The fib isn't always going to work on every single leg. Like for example, if I pull it from here to here, like it almost taps relative equilibrium, but it doesn't. Then I pull it on the next leg from this impulse. Here again, we don't get tapped in. And a lot of times it'll do that, but not always. I would say over half the time it will come back into discount as you're buying. And if it doesn't, that's totally fine. Like this stretch kind of isn't the greatest for the fib, but a lot of times you'll find that it does work. For example, here, price moves. And you can see we come back to the 50%. And like I said, I like to use the fib on the daily and the 4 hour mostly, and I do use it a little bit on the 15-minute, but not as much. But it can be handy, and there's several ways of using the fib, and I'm going to kind of talk about that in a second. I think you guys get the idea. The idea is if we're selling and order flow is bearish like it is here, we're just looking for a decent place to sell from. Basically, if we're involved in this leg, we don't really want to be selling from here. We want to wait till at least relative equilibrium at a bare minimum to get involved, and whenever possible, obviously we want that premium pricing. But depending on the way the market forms, that's not always the way it's going to work out. But more often than not, price will come back to that 50% or relative equilibrium. Now, this is important for two things. So if we're trading with trend, you're obviously wanting a decent price, so relative equilibrium or premium preferably. Now, the other way of using the fib is if we know 4 hour order flow is bearish and we're playing a pullback, one other way of using the fib is where can I safely play this pullback to? Well, more often than not, they are going to tap the equilibrium or at least the relative equilibrium. So you know that when price starts going up, you can safely take buys to at least this point, maybe even 50%. As price gets past that 50%, you know that more than likely the 4 hour trend is going to take over, and that maybe it's not a good idea to keep buying once price is past this point, and maybe it's time to start looking for sell ideas again as price has achieved relative equilibrium. And now we can start at resuming higher time frame order flow. And I always like using the fib anytime I'm going counter trend, just to let me know where the trend is likely to stop. So even if we just jump on the 1 minute quick, which is going to be your execution time frame, a lot of times, this would be the high of a 15, this would be the low of a 15, and essentially, again, if you are playing the pullback, you're going to have your fib pulled from the high to the low, and if you are deciding to get involved in the pullback, you know that once price has achieved that relative equilibrium, it's going to be a lot less probable to keep buying. Yes, in this case, it does keep coming into the premium territory, but if you're still taking buy orders in here in a bearish scenario, more often than not, you are going to get, you're going to lose money. So it's best to always be involved down here. And as price gets up higher, we're just going to wait for order flow to shift and higher time frame order flow to resume. So here we basically, if you were to frame this, this would be your 15 order block. And basically your very premium price, order flow is bearish. You could say this is a weak low, and that would be your target to run. Now, what you're looking for is essentially a change of character to let you know the market is shifting and order flow is going to resume. Here you have a last sort of a demand level that put in a new high. And we will get into this stuff in a little more detail, but I just basically want to show you guys how to use premium and discount to frame a trade. It might give you guys an idea of what's to come to. So we have a change of character on the top, and we have a change of character on the bottom. And all a change of character is essentially you took the highs and lows, you wiped the liquidity. Now, you're very well priced, so in this case, You have a demand level here that sort of fails. And the area that causes the failure is ultimately something in this zone. And we'll get to all this in more detail. And essentially what you're doing is just selling in premium. And you're following order flow. Now, you could partial this out sooner if you want, but more often than not, we can frame a trade based on higher time frame order flow. And this is a 17R. This trade is properly priced. You're in premium pricing. You're following higher time frame order flow that is bearish, so it is much higher probable that you'll make money taking sells. And that's all I really like using the fib for. So if we're playing the pullback, up to the 50% is safe. Anything beyond that, if you are taking buys when you're counter trend, make sure you manage really quick, basically get risk out of the market, and we'll cover that as well. But that's basically all the fib is used for. Don't overthink it too much, and it's not going to work every time, but most of the time the fib will help you set up good trades. You can also, depending how your management and your psychology is, you can even make a rule that you're not going to take a trade unless all your confluences align. Or as you get more experience and you start viewing the market different, you may choose to only use the fib on the higher time frame or only as a guideline. But as a beginner, I would just recommend giving yourself the highest probability setups so that you can have a high probability of winning. You don't need to be in every trade, you just need to be in every high quality trade that's got a higher probability of going. So I'm not really going to keep beating this topic over and over. I think you guys get the point. As we get into other sections of this course, you'll kind of see how the fib integrates into the whole system, and whether you choose to use it or not is completely up to you, but I promise you it'll save you a lot more losses if you do choose to use it than the wins that are going to go without you. Yes, you'll miss trades, but you'll miss way more losses than wins, so it's not a big deal. This is a long-term game. Anyway, I'll see you guys in the next video.